Hi. Welcome to Solutioninn YouTube channel. In today's video we will learn about retained earnings. The retained earnings are a component of equity that is not distributed to ordinary shareholders and is retained for further investment purposes. Retained earnings can include undistributed profits and other reserves such as additional paid-in capital or revaluation surplus on fixed assets. As per accounting standards, revaluation surplus and decline is also included in the retained earnings. The retained earnings is now a compulsory item of stockholders' equity area where it is shown as a separate item on the balance sheet. There is also a separate financial statement, called Statement of Retained Earnings, to show the movements in the retained earnings during a year. This is very important to shareholders to know about how much a company is distributing and how much it is retaining. If the company is making more profits, but paying lesser dividends, the shareholders will think that either company has used the undistributed profits to expand, repay its debts, or to earn return by investing it somewhere. If this is not the case, and company is not growing, and yet dividends are lower, the shareholders will need an explanation. So the shareholders will ask management to explain where the retained profits are going. To see this, there is a separate financial statement called Statement of Retained Earnings. For simplicity, the general format of Statement of Retained Earnings is as follows. Let's take an example to see how it is shown in financial statements. Assume a company has opening retained earnings balance of $0 since it was the first year of its operation. After 1 year, the company reported a profit of $90,000. Out of these profits it paid $36,000 as dividends. Hence the retained profits will be $54,000. The decision to retain the earnings or to distribute them among shareholders is usually left to the company management. However, it can be challenged by the shareholders through a majority vote because they are the real owners of the company. Management and shareholders may want the company to retain the earnings for several different reasons. Being better informed about the market and the company's business, the management may have a high-growth project in view, which they may perceive as a candidate for generating substantial returns in the future. In the long run, such initiatives may lead to better returns for the company shareholders instead of those gained from dividend payouts. Paying off high-interest debt may also be preferred by both management and shareholders, instead of dividend payments. On the other hand, when a company generates surplus income, a portion of the long-term shareholders may expect some regular income in the form of dividends as a reward for putting their money in the company. Traders who look for short-term gains may also prefer dividend payments that offer instant gains. Most often, the company's management takes a balanced approach. It involves paying out a nominal amount of dividends and retaining a good portion of the earnings, which offers a win-win. Now you have the basic understanding about the retained earnings and how important it is. If you liked the video, please hit the like button and don't forget to subscribe. See you in next video. Take care.